Welcome back to BNN Bloomberg and our special coverage of the Bank of Canada's most recent rate decision. As expected, the Bank of Canada has cut its overnight lending rate, its benchmark rate, by 50 basis points. That rate now goes down to 3.25%. The bank has, however, removed some language that earlier promised further cuts if its economic forecasts materialize. And that has been perceived, as our panel has explained, that has been perceived by markets as a bit of a hawkish tilt to the bank's statement today. And one thing we have seen in reaction to that is a significant appreciation in the exchange rate, the price of the Canadian dollar as measured in US dollars. Now we're going to explore what the rate means for the housing market in Canada. Warren Lovely and Bipan Rai are back with us. We're also joined now by Christopher Wein. Christopher Wein is Chief Operating Officer at Equiton, a developer. It's a developer that builds multi-residential, low-rise and commercial properties in the GTA. In other words, the perfect person to talk about the effect that this decision could have on the real estate market. Christopher, thank you for joining us.
Thank you.
We really appreciate your time. First of all, just to explain briefly your company, what it does and what its place is in the property market.
So we have a significant portfolio of purpose-built rental buildings throughout Ontario and in the Alberta market, and we're looking to expand that into the BC market as well. Mm-hmm. And then in addition to that, we are a developer. So we do low-rise, high-rise, mid-rise, condominium and purpose-built rental.
Okay. What's your take on a 50 basis point rate cut? What will we see in the mortgage market, and how might buyers and sellers respond?
Sure. It was expected, so I'm happy that they came through with the 50 basis points. We need that because I think more importantly than just affordability and mortgage rates, we need to build confidence within the home building community and within home ownership in Canada. And I think that's what's really, we have a lot of people sitting on the sidelines that are waiting to see mortgage rates stabilize. And I think this helps a lot. The other thing that we were very concerned about was renewals. Coming into 2025, we have a lot of renewals that were coming through at much lower rates. And I think it was very important that now people are able to renew with some peace of mind.
Right. Are participants waiting for mortgage rates to stabilize or for mortgage rates to come down?
I think we need to see some more cuts. I think that we're not going to see the housing market really rebound until the third, fourth quarter of next year. We are starting to see a little bit of leading indicator in the actual new home market, as in single family homes. That's always the first indicator as we see sales pick up there. Then ultimately multifamily comes behind that. Mm-hmm. So I don't think the condo markets are going to rebound really until the fall.
Do you expect to see the rates offered on variable rate mortgages drop by 50 basis points tomorrow?
No, I do not. And I think the challenge, well, one of the things that's interesting is as home builders and developers, this is very important for us as well, because people forget that when we're doing new builds, we borrow approximately 65% of the capital stack. Right. And we have to borrow at variable rates. So a lot of the affordability issues around housing come from the fact that we've been paying such significant lending rates that we had to pass it on to consumers. So this is going to help developers to get going and get started with projects. It's probably going to start to see the land market move a little bit. We haven't seen any significant trades in development lands throughout the GTA or even across the country for at least the last 2 years. So we need to start to see things move again. And this 50 basis points will help, but I think we need to see at least another 50 basis points through the spring.
Okay. Warren Lovely, what do you think this will do to real estate markets around the country?
Well, I like the way Christopher termed this, the sort of the confidence channel is something we really need to think about. And, let's be frank, we've been suffering from a lack of confidence in Canada, not just in housing markets, but more generally, right? Consumers generally aren't that confident. Businesses are lacking confidence. So to some extent, getting interest rates out of restrictive territory to now maybe in this sort of notional neutral zone, and hopefully even lower still, will, with time, with patience, get us into a situation where we can start growing at a more acceptable potential sort of style of growth. But I tend to agree with Christopher here. I think we still probably need to be a little bit patient.
Bipan, what's your take?
Yeah, I think, from the confidence point of view, what the Bank of Canada did today and what it's projected to do will help at the margin. But let's remember that the bank's tools really only address the demand side. I mean, there's still some considerable supply side issues in terms of input costs, in terms of where you can build that I think are going to be constraints for this sector going forward.
We've heard a lot about that, those supply side constraints. That's your business, yes. Christopher. Have governments, all three tiers of governments, how much progress have have they made at making it easier for developers to develop new housing?
They're moving in the right direction, but it's still very slow. I was pleased with what the federal government did around mortgage rules and increasing insured mortgages to 1.5 million. What I think they need to do as well, and I've actually spoken with the housing minister about this, is relieve GST on first-time buyers up to $1.5 million. I think that's very, very important. With respect to the municipal governments, they're starting to move in the right direction. It's still very slow to get approvals, but recently here in the GTA, Mayor Chow, she provided a waiver on DCs for purpose-built rental, which is great. And the federal government also has the HST or the GST holiday. The provincial government has the HST holiday on purpose-built rentals. That's all fine and dandy, and we build purpose-built rental, but we still, in order for the economy to drive forward, we need home ownership. And this is what I was speaking to the feds about, is you can't create a class of rental people and that's it. Like, the next generation can't just be permanent renters. So if we don't start doing things to help move people from rental class into home ownership, like a GST holiday, and getting faster approvals and bringing down the cost of development charges, we're going to get, we're not going to help the Canadian economy long term. It's a problem.
Is that realistic to have future levels of home ownership be in line with past levels, where homes now in the Greater Toronto area are well more than $1 million?
Well, I think the other thing we have to look at is what do homes look like in an urban environment? So if we look at other cities around the world and other great capitals, the apartment style housing is generally what's accepted in the urban environment.
Right.
So
in other words, condominiums.
Condominiums, right. Exactly. And I think if you think about it, you can raise a family in a condominium as long as it's the appropriate size and you have the appropriate amenities. And if you're in a downtown urban core, you don't need cars, you have public transit, you have the 15-minute sort of neighborhood. That's really the future. The idea that everyone's going to have a single family home, not in major centers like Vancouver, Montreal, and Toronto. That's not possible.
Warren, what's your take on home affordability right now in the current context?
Well, I mean, I think, look, to Bipin's point, the Bank of Canada, in regards to this decision, is pulling the one tool that it has available to it, right? So in terms of trying to impact the cost of borrowing, the Bank of Canada is made the right decision today to move down aggressively on the policy rate. I don't think they're done here. I think additional relief will be needed. That'll be one ingredient in terms of restoring a degree of affordability and confidence, as Christopher mentioned. Again, I don't think we should be declaring victory here. Oh, we've got to neutral, and so we've done enough, and maybe we'll do a little bit more. I think it's pretty clear that we still need to do more for an underperforming economy and for a housing market just generally, and for interest rate sensitive demand that is still not nearly as robust as we're going to need it to be, given the other challenges that we face in this economy.
Bipin, we've seen in the past where interest rate reductions, or even when the bank was on the way up on interest rates, an unexpected decision to pause and not raise rates ignited in a fairly big way housing activity around the country and caused upward pressure on prices. What are your thoughts on that dynamic, and might we see that now?
Potentially. I mean, a lot of it is tied to behavioral economics, which is outside of the scope of what I'm good at, let's say, right? But I mean, I do think that, if we do see sort of momentum lower in, say, interest rate costs driven by the Bank of Canada, I mean, that'll be reflected in the cost of borrowing. And of course, that is going to affect herd mentality, right? So at some point, maybe mortgages get to a low enough level, maybe, enough borrowers have refinanced at a level that isn't as punitive, so we don't see as much, savings increase, that maybe we start seeing spending in other sectors, including housing again. So that is something that potentially could be a theme to watch for towards the end of next year, as Christopher mentioned.
Christopher, same question to you. You don't seem to be calling for that, a spike up in activity based on a decision like the bank made today. Is that correct?
That's correct. Yeah, I think it's a very slow elevator ride back to a sustainable housing market. This is not, we're not going to see a spike. The one good thing we are seeing...
What has changed then? You remember the day I'm talking about when the bank did not raise its rates, and we saw almost immediately a spike up in buying activity, correct? What has changed? The direction of rates? Is that what's different?
I think the direction of rates, and then also I think we're still suffering with an oversupply in some cases of existing product. So don't forget that in the GTA, we're still sitting with probably 30,000 constructed units that are unsold.
These are these condo units?
These are condo units, and they're very small small condo units. That's one of the other things too. Is we became very investor driven. So unit sizes kept shrinking and shrinking and shrinking because investors were looking for returns. The less they spend, the greater the return. Now we have to, I think, adapt as a housing market and really look at what do Canadians need in order to raise families and live comfortably and profitably within their homes.
Very quickly, last question to you. What does the condo market look like elsewhere in Canada?
It's the condo market, generally speaking, is tough everywhere. What's interesting is where housing is doing its best is in the prairies, more so than the major centers. So,
gentlemen, I want to thank you all three of you for a great conversation. Thanks, Christopher, for your expertise on the real estate market. Thank you, Warren and Bipan, as well, for your expertise on the Bank of Canada and the